Here at TS Lombard, we have a very high conviction view that the trade war between the US and China will continue to escalate to the extent that the US will apply 25% tariffs on almost all imports from China, and China will retaliate qualitatively and quantitatively in response. And in a survey that we conducted in our September seminar, investors in large part agree with the idea that there will be further escalation. 75% of investors said that they would expect more escalation beyond the 10% on 200 billion, but only a few, 6%, expected escalation to 25% on everything. And in the Bank of America Fund Manager Survey, there's a similar outcome. Investors do regard the trade war as a key tail risk, but not as a central case. So the question is why further escalation is not discounted in the market at the moment. The US equity markets continue to make new highs. And I think the answer is in the way the market finds it difficult to price both large bimodal events, like a trade war, and events which are taking place in a few months' time, long-term events. Because we saw at the start of September that the market was discounting the risk of a 25% escalation, and in the end a 10% escalation saw a bit of a relief rally. So what we would expect to happen towards the end of the year, as the G20 at the end of November may see Trump and Xi meeting, and then there may be further negotiations between G20 and the end of the year, we'd expect to see the market bring the trade war back into focus and start to insure against the downside risks. We don't think the market's doing that at the moment because it costs too much, and the tyranny of the benchmark, that is, investors need to keep up with their peers, just means that investors can't afford to continue to hedge against downside risks that may not emerge within the next few weeks or month. So that means by the end of the year we would expect there to be fairer pricing of trade war risks, but that still doesn't preclude the chance of a large downward move if the trade war escalation continues as we expect. And that downward move would reflect a market move into the bimodal outcome and the new normal of a trade war world.